Welcome to Upgrade Your Worth, the channel where we talk about money, the mindset, and making your life better one step at a time.
That's right. We're here to break down financial literacy and self-improvement in a way that's simple, practical, and actually fun.
From saving and investing to building better habits and boosting your confidence, we're going to give you all the tools to upgrade not just your wallet,
But your whole life.
so if you're ready to stop feeling stuck and to start building real wealth,
Hit that subscribe button, turn on the notifications, and join us on the journey to upgrading your worth.
let's grow together. Welcome back to Upgrade Your Worth. Today we're going to dive into Investing 101, the basics you need to know to start building your wealth.
That's right. A lot of people feel like investing is complicated or only for the rich, but in reality, it's something everyone can do. And the sooner you start, the better.
So stick with us just for the next few minutes. So by the end of this video, you're going to understand what investing is, why it matters, and how you can get started even with a small amount of money.
First things first, what exactly is investing? In simple terms, investing is putting your money to work so it can grow over time.
So instead of just letting your cash sitting in a savings account earning almost nothing, you want to buy assets. Now, asset classes include stocks, bonds, real estate, and we'll dive into many more later. And they all have the potential to increase in value and generate income.
Think of it like planting a seed. At first, it's small, but with time, patience, and care, it can grow into a tree that produces the fruit year after year.
And that fruit would be your return on investment. So the profit or the income you make from the money that's working for you.
So, why should you even invest? Well, inflation is a big reason. If your money just sits in cash, it actually loses value over time because prices keep rising. Now, why do prices keep rising? Because the US dollar has lost a significant amount of value over the last 100 years and it's accelerating more and more.
Exactly. So a dollar today won't buy you as much as 10 years from now. So investing will help your money grow faster than inflation so you're not falling behind.
And here's the kicker, investing is how people build real wealth. Retirement savings to financial freedom, it all starts with putting your money into things that grow. Earlier he mentioned stocks. Stocks right now, I think worldwide there's about $100 trillion asset class. In terms of real estate, 300 trillion. In terms of bonds, I think another 300 trillion. So these are very large asset classes that if you take part in any of them at all with with good information, you can actually take a little piece of that pie.
Yep, and that's exactly right. So based on what Noah just said, let's go over the main types of investments. He mentioned stocks. That's buying ownership in a company. So if the company grows, so does your investment. We have bonds. Bonds are basically when you lend money to a company or the government and they pay you back with interest. And then you have one of my favorites, which I encourage everyone if you're just starting to learn about investing to invest in. That's mutual funds and ETFs. And these are pools of money from many investors to buy a mix of stocks and bonds. And they're a great option for beginners. And real estate. Real estate is a key component into every successful person's financial portfolio. Buying property to rent out or sell later at a higher price.
And each type has its own risk and rewards. But the key is diversification. Spreading your money across different types of investments so you're not putting all your eggs in one basket.
For beginners, you need to start with index funds or ETFs. It's usually the simplest and the safest route to go. They're low cost and they give you exposure to hundreds of companies all at once.
part of investing is understanding risk. Generally, higher potential rewards come with higher risk.
So, for example, stocks can grow quickly, but they can also drop in value. And bonds, they're usually safer, but they grow at a slower rate.
The trick is finding that balance that works for you, based on your goals, timeline, and how comfortable you are with the market ups and downs. My suggestion would be to a person who is, for me, a person that's considered, hey, look, I'm low risk. Hey, I'm older now. I got kids or grandkids, and you want to make sure that they're okay. You can go with bonds. Real estate should be a huge part of your portfolio because in the event of you leaving this world, we want to make sure that they have the assets that you want them to have, something that goes up in value. And with bonds are basically a way for you to always have cash. I think you can have a 4-week bond, you can have a 3-month bond. There's a lot of liquidity when it comes to it. And then on top of that too, in terms of bonds, some of the best bonds are in America because the government is in so much debt. So it's one of the biggest economies in the world. So they always want to make sure that they pay money out so they can even finance their operations, and that could be money in your pocket.
Now, remember, risk doesn't always mean bad. It just means that there's uncertainty. So over time, especially when it comes to decades, the stock market has consistently grown despite short-term ups and downs.
Okay, so how do you actually start investing? Step one, open an investment account. That can be with the brokers like Vanguard, Fidelity, or even apps like Robinhood or Acorns.
Step 2, you need to decide on your strategy. If you're brand new, a simple approach is to invest in the S&P 500 index fund. This gives you a piece of 500 of the largest companies in America.
So this is my favorite. Automated. Set up automatic contributions each month, even if it's just $50 or $100, because consistency is the real secret weapon.
And here's another pro tip. Do not ever try to time the market. Focus on time in the market. The longer your money is invested, the more compound growth can work in your favor.
So before we wrap up, let's quickly go over a few mistakes beginners often make. Trying to get rich quick. Investing is about patience. Putting all of your money into one stock or trend. That is the complete opposite of diversification. Panicking and selling when the market dips. Now, there's a couple different things with this. Now, in terms of trying to get rich quick, when we say that, that's basically throwing your money, your time, effort, and energy into things that could potentially blow up in your face. Whether it's a brand new company that doesn't have established earnings, whether it's the new crypto coin that everybody's going crazy about, but you're not doing it any research and looking into the information behind those projects, and then you're left with something that they call a poop coin. And also panicking and selling when the market dips. Now, I'm a huge believer of access to information, and that's the most important thing on your financial journey. But there's in the age that we live in, there's too much information. You can get it on social media, you can get it on your TV. It's all over. So when it comes to certain things, you have to understand as an investor of whatever company that you pick, you have to believe in them. You believe that whatever is going on in the market, because there will be times where the market rises. There will be time when the market falls. So your best bet is to take stake into a company, into even down to the CEO or up to the owners of the company that you believe in. And if you believe that they're gonna make it out of the storm, you hold on to that. Because in the event of you always selling and basically like liquidating your account, you're stacking up fees, you're not learning. You have to understand that in this, the best thing is time. So that's just what I wanted to go over.
No, that's awesome that you brought that up, because the truth is, dips are normal. They're part of the process. The people who win in the long run are the ones who stay invested and keep adding money consistently. So remember this, you always want to buy low, sell high. So when the market dips, Don't be like everyone else and panic and start trying to sell. No, this is the time for you to actually buy more. And then when the market rises again, you're going to reap the benefits of it exponentially growing. So remember that rule of thumb: buy low, sell high.
So here are the key takeaways. Start early. Stay consistent. Diversify your investments and think long term. Now, when we say diversify your investments, especially when it comes to stocks, I know stocks, literally the S&P 500 has 500 companies, and we understand that's a lot to break down. But when we say diversify, just keep it basic in terms of industry. They call consumer staples like Costco, Walmart. People are going to always buy groceries. Earlier, I heard something about waste management. Is there always going to be garbage? People always going to drink Pepsi? So when we say diversification, we mean spread out your money into different industries. And remember, when you put your money into that company as a stockholder, you're part owner of them. So you got to look around in your own communities. You got to see who you're paying your monthly bills to, whether it's T-Mobile, whether it's AT&T. Did you just buy a Tesla? These are the things that we want you to start thinking about when you're waking up every day using these products, just to make it a little easier on yourself.
Yep, exactly. And investing is not about luck or being a genius. This all takes discipline, it takes patience, and the willingness to let your money grow organically.
And if you found this helpful, hit that like button, subscribe for more financial tips, and share with a friend who's ready to start investing.
Thanks for watching, and we'll see you in the next one.